Kids are now back in school, spring break is over, and we're back to work here at Pilot. Last week, there were 3 key pieces of information that I wanted to cover in this video this week. The first one being, of course, what every Canadian is looking at daily here is our upcoming Canadian election. We had both Mark Carney as well as Pierre Poilievre on the campaign trail last week, making new promises to Canadians in terms of what their platforms are going to look like. The one that I wanted to highlight specifically that stood out to me was the capital gains reinvestment from Pierre Poilievre and the Conservatives.
We need a change with a Canada First government that will axe taxes, build homes, approve resources, bring home the hundreds of billions of dollars the Liberals have pushed out of the economy so that we can stand up to the president from a position of strength.
But the highlight of it is that if you were to incur a capital gain from the sale of assets, that should it be reinvested in Canada, that capital gain could be delayed to the future. So stark difference from what we were seeing last year from the Liberal Party that wanted to increase capital gains tax. That proposal has been completely scrapped. But these new proposals that we're seeing from both Pierre Poilievre as well as Mark Carney in terms of taxes here in Canada could be beneficial for the overall market. Second thing that we saw last week as well, GDP growth in Canada specifically. So through January, you actually saw the Canadian economy expand. I don't know that this will be long lasting. When you take a look at economist predictions moving forward, the expectation with the tariffs in play now is that the Canadian economy will begin to struggle and we could be in a recession by as early as the summer. When we look at tariffs specifically, that GDP growth, a recession for Canada, the other side of it that we have to constantly keep in mind is the inflation side. So when you look at the economic data coming out of the United States for last month, inflation was up, and the expectations for inflation over the coming months and years have also increased. So we had the University of Michigan release data in terms of forward projections for inflation, and now the expectation is that inflation will be higher in the years to come here, specifically due to the tariffs and that potentially becoming ingrained in both economies and consumers' minds. So something very interesting to pay attention to. It does directly correlate to where interest rates could potentially be in the future. When you take a look at the predictions now from major banking institutions here in Canada, Scotiabank specifically has noted that they no longer expect any further rate decreases here in Canada. You do have other banks such as RBC and TD that do still expect further discounting in terms of that prime rate. The key here is that there's a lot of uncertainty in terms of the market, and it makes it very difficult to predict. Even when you have key economists from these banking institutions that have no idea where this pricing is going to be, and there's a big disparity in terms of opinion from each of them, it tells us that with all of the uncertainty at play, it's very difficult for them to nail down where we may be in the coming months. That leads us to when we take a look at Canadian interest rates and recommendations for Canadians. If you have any mortgage professional at this point in time, or any individual for that matter, telling you exactly which mortgage product you should be taking, I would run from that individual immediately. When we look at interest rates today, there are a number of different options between variable rate mortgage, fixed rate mortgages, and the terms of those mortgages, whether they are 1 year to 5 years or longer than that. And when you look at the predictions for the market, what we need to look at is measuring your risk appetite specifically. There have been a lot of Canadians that have been on the rate roller coaster for the last 2 years in terms of variable rate mortgages that would probably like to get off. If we're getting towards the bottom of the easing cycle now in terms of those rate cuts, we do have to start to take a look at, is now a good time to potentially start to consider fixed rates? That could be coming in the coming months. When you look at interest rates historically, if we can get 5-year, 3-year rates that are sub 4%, which we're just starting to see now, it could be a good time to potentially pivot over into that in the coming months. So definitely reach out to your mortgage professional, figure out where you're at today, take a look at your own finances and whether or not you want to continue to ride on the mortgage rate roller coaster that can be variable rate mortgages. There could be greater discounting and savings available, but there also could be higher rates in the months to come with the inflation being present. I'm Tyler Wilson. Thanks so much for your time, and I'll chat with you next week.